Something changed in your wallet and you can't identify the cause. Not one big hit, a dozen small ones, spread across groceries, a gas station, a flight you priced out, a credit card statement that looked slightly wrong. Each one explainable on its own, each one adding up to a feeling you can't shake. What you're sensing is real, and it's going to get louder before anyone officially explains it. Economic disruptions don't announce themselves. They don't send calendar invites. They arrive in disguise, as a grocery receipt that's $10 higher than expected, as a summer trip that somehow costs half again what last year's cost, as a credit card balance that shrinks slower than it should. Right now, most people are watching one signal and missing four others. Here's what nobody is connecting yet. What you're feeling today and what you'll feel in October are caused by the same event. They just haven't finished traveling through the system. By the end of this, you'll understand why the damage feels random, how far it still has to go, and the specific adjustments that separate households that come through these disruptions intact from the ones that come through weaker. I've spent a long time looking at how economic shocks move, not the headline version, but the actual mechanics of how a single disruption in one place becomes a price increase in your kitchen 6 months later. The pattern is consistent, and it's almost never what people are watching for. Section 1. The architecture of a slow disaster. Here's the first thing to understand about the economic situation you're living through right now. It isn't one crisis, it's a sequence. Think of it like a line of dominoes placed at unequal distances apart. The first tile falls, and you can see it. The second and third fall quickly, you notice those too. But the fourth and fifth are far enough away that by the time they fall, most people have stopped looking at the line. They assume whatever hits them in October arrived from somewhere else entirely. The Strait of Hormuz, a 21-mile passage connecting the Persian Gulf to the open ocean, carries roughly 20% of the world's seaborne oil supply. When that passage faces serious disruption, the effects don't land all at once. They propagate through interconnected systems on different timelines, each dressed up in a different disguise when they arrive. The first effect is the one you can already see: fuel prices. National averages have risen sharply. Diesel, the fuel that powers freight trucks, farm equipment, and the refrigerated vehicles moving everything perishable, has surged over 40%. This matters far more than what it costs to fill your car. And here's the part that almost nobody connects right away. When diesel costs more, everything diesel moves costs more. The pricing mechanism is documented and fast. Freight carriers pass the majority of fuel surcharge increases through to shippers within 30 to 60 days. Those shippers pass it to retailers. Retailers hold as long as they can, then they don't. The transmission is already in motion. You just can't see it in your grocery total yet. The people who come through disruptions like this in better shape aren't the ones with the highest incomes. They're the ones who saw the sequence early enough to move before the pressure arrived. Section 2. The timelines nobody is publishing. This is where it gets genuinely strange, because the most damaging wave in this sequence is the one that lands last, and it connects back to decisions being made right now in farm country. Nitrogen fertilizer is synthesized from natural gas. It's what allows a given acre of farmland to produce several times what it otherwise would. The world's fertilizer supply chains pass through some of the same choke points as its oil supply. When those routes face disruption, fertilizer prices respond almost immediately, but the crops those fertilizers grow take months to mature. Spring planting decisions made in March and April determine what lands on shelves in October and November. The fertilizer costs of today are the food prices of fall. This cause and effect relationship is well documented in agricultural economics, and it's nearly invisible to most consumers because the delay is so long that the two events don't feel connected at all. By the end of this, you'll understand why the damage feels random, how far it still has to go, and the specific adjustments that separate households that come through these disruptions intact from the ones that come through weaker. By October, you might find yourself standing in a produce section looking at prices that seem inexplicably high, mentally reviewing your budget to see what you changed. You didn't change anything. The price of a field input 6 months earlier made its way to a shelf. Most people will never make that connection. You just did. And here's what makes the timing even more significant. The other waves land well before October. Grocery prices, driven by diesel freight costs, not fertilizer, have seen analysts project increases of 15 to 30% for summer bookings, with some budget routes already reflecting those adjustments. The household absorbing a gas increase, then a grocery increase, then a vacation that costs more than planned, arrives at October already stretched. That's when the fertilizer wave hits, and by then, the emergency budget cushion that could have absorbed it has been quietly drained by the waves that came first. Section 3. The interest rate trap. Most people were expecting relief this year. At the start of 2026, markets were pricing in multiple Federal Reserve rate cuts, lower mortgage rates, relief on auto loans, some breathing room on credit card balances that have been compounding at 21 to 24% for years. That expectation shaped real financial plans. People delayed refinancing, people paused home purchases, people carried card balances they planned to address once rates came down. The rate cuts aren't coming. Not this year, possibly not next. Here's the structural problem. When an energy shock pushes prices higher across the economy, the Federal Reserve's job is to fight that inflation, which means keeping rates elevated or raising them further. At the same time, that same energy shock is compressing consumer spending and straining corporate earnings, which creates pressure to lower rates to stimulate the economy. Those two imperatives are pulling in opposite directions simultaneously. There is no clean resolution to that conflict. The Fed can't cut without risking accelerating inflation. It can't raise without risking tipping an already pressured economy into contraction. The practical consequence? Americans carrying $1.27 trillion in credit card debt at 22% interest are going to be carrying it longer than they planned. Households waiting to refinance or buy at better rates are going to wait longer, and every month of waiting at 22% is a compounding tax on inaction. This is the wave that doesn't show up as a line item, it shows up as a number that won't go down, and it's the wave that tends to matter most over the full 12-month arc of a disruption like this. Section 4. Why your brain is working against you right now. Here's something that's genuinely important to understand, not about oil markets, but about your own cognition. When people encounter a multi-layered problem, the brain doesn't process all layers simultaneously. It identifies the most visible, most concrete data point, and uses that as a proxy for the entire situation. Psychologists call it the anchoring effect, and it's not a character flaw. It's how attention works when there's too much information to hold at once. Right now, for most people, the anchor is the gas station price. It's visible, updated daily, and impossible to ignore. Because that number, annoying as it is, feels manageable, the entire situation gets mentally filed under temporary inconvenience. This is exactly what happened in 2022 after a different geopolitical shock disrupted energy markets. Most people's initial read was, gas is up, that's frustrating. The broader inflation that followed, which eventually reached levels not seen in 4 decades, caught the majority of households well after the adjustment window had closed. By the time the full scope was legible, the purchasing power had already eroded. Recognizing this pattern doesn't require perfect forecasting. It requires understanding that when an energy supply shock is large enough and sustained enough, the visible wave is not the whole story. It's the announcement that additional waves are in transit. The most expensive response to that announcement is to do nothing while waiting for certainty. Section 5. What prepared households actually do. Let's be precise about what preparing means here, because it isn't dramatic and it isn't complicated, and that's precisely why most people underestimate it. The gap between households that fare well during economic disruptions and households that don't is almost never about income level. Consistent research across multiple shock events, energy crises, financial panics, supply chain breakdowns, shows the same pattern. Early, unglamorous adjustments compounded across 6 to 12 months create outcomes that look like luck from the outside. The mechanics are specific: an emergency fund of 3 to 6 months of essential expenses, not total spending, essential spending, held in a high-yield savings account currently paying 4 to 5% annually, removes the most dangerous variable in a period like this. When a car repair or medical expense arrives while grocery and fuel costs are simultaneously elevated, the household without liquid reserves doesn't get to choose between good options. It defaults to high-interest debt. That debt then compounds at 22% through a period when rates aren't falling, and what started as a $900 repair becomes a 2-year anchor. The household with a cash cushion has a different experience. The same event is an inconvenience. The budget adjusts. No compounding cost follows. On investments, every major market downturn arrives feeling like the one that's different. Research tracking large populations of investor accounts across multiple market cycles has found that the average equity investor has dramatically underperformed basic index funds, not because of bad individual stock selections, but because of one behavior repeated across every cycle: selling during sharp declines and returning to the market after significant recovery has already occurred. The days when the market recovers most sharply tend to cluster immediately around the worst days. Investors who exit during the worst days miss the best days. That gap, compounded across decades, is the difference between building real wealth and treading water. The correct action during a period of elevated volatility is the least emotionally satisfying one. Maintain contributions, don't exit, automate what you can, and reduce the number of decisions that are made under emotional pressure. On high-interest debt, paying off a card charging 22% annual interest is mathematically identical to earning a guaranteed 22% return with no market risk. That return doesn't exist anywhere else. Attacking it aggressively during a period when rate relief isn't coming isn't optional. It's the highest return financial move available to most households. None of this is exciting. None of it makes a compelling story at a dinner party, but it is exactly what separates the households that exit a disruption in better shape from the ones that exit having absorbed the full impact of every wave without a buffer between them. When you started watching this, you had a vague sense that something was off, a feeling more than a diagnosis. What you understand now is that the feeling was accurate, but the scope was larger than a single gas price. You were sensing the beginning of a sequence, not the whole event. The waves that follow are real, the timeline is documented, the mechanics are understood. That changes what the right response looks like. Not anxiety, not paralysis, adjustment. The honest summary: a significant energy supply disruption doesn't produce one price increase. It produces cascading effects that travel through interconnected systems on staggered timelines. Fuel first, then freight costs, then groceries, then agriculture, then airfare, while interest rate dynamics freeze the monetary relief most households were planning around. By the time the full picture is legible, the window for proactive response has often closed. The households that fare best aren't more fortunate, they're earlier. They adjusted before the pressure fully arrived. That window is still open, but it won't be indefinitely. The identity close. You spent 20 minutes understanding something that most people will spend the rest of the year confused about. That's not a small thing. That's the difference between watching something happen to you and understanding it well enough to make deliberate choices inside it.
The moves are simple: an emergency cushion in a high-yield account, high-interest debt attacked now, investment contributions maintained through volatility, summer travel decisions made before pricing catches up, and discretionary spending trimmed before the later waves land. Do the unglamorous version of this now, and what's currently a disruption becomes something you navigate rather than absorb. If you want to go deeper on how to build the financial foundation that makes disruptions like this manageable, debt payoff structure, investment mechanics, understanding how inflation actually works, the next video covers exactly that, starting from the basics and building to the systems that hold under pressure.